Druckenmiller exits Alphabet, not with a whisper, but with a complete liquidation that sent shockwaves through the institutional investment world. In the first quarter of 2026, Stanley Druckenmiller's Duquesne family office sold its entire 385,000 share position in GOOGL, a move that stands in stark contrast to aggressive new buys by other elite funds. The timing is critical. This exit happened while Alphabet shares were underperforming, dropping 8% during the January to March window, even as the stock has since rebounded to climb 27% year-to-date. The real story isn't just the sale, it's what it reveals about diverging convictions among the most influential minds in finance. The data comes from mandatory 13F filings, regulatory snapshots that expose holdings as of March 31, 2026. These are not speculative rumors, but verified positions, making Druckenmiller's exit one of the most concrete signals of shifting investor sentiment this quarter. Duquesne didn't just trim its stake, it wiped it out completely. That kind of decisive action from a legendary macro investor raises immediate questions. Was this a tactical retreat, a strategic rebalance, or a deeper loss of confidence in Alphabet's trajectory? And more importantly, what does it mean for other institutional holders watching these moves closely? Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. While Druckenmiller exits Alphabet, others are doubling down. Christopher Hohn's TCI Fund Management launched a fresh 2.46 million share position in Alphabet Class A stock and expanded its Class C holdings from 7.6 million to 8.85 million shares. This aggressive accumulation suggests that, for some, Alphabet remains a core long-term bet despite short-term headwinds. TCI's move wasn't isolated. It also boosted stakes in Visa, S&P Global, and Moody's, signaling confidence in high-quality financial and data infrastructure. But even TCI made a major retreat, slashing its Microsoft position from over 16 million shares down to just 2.73 million. This wasn't a portfolio-wide tech pullback, it was a selective realignment. Back at Duquesne, the story extends beyond Alphabet. Druckenmiller's fund nearly eliminated its Amazon position, cutting shares from over 737,000 down to just 9,539. That's not a reduction, it's a near-total exit. At the same time, the fund launched new stakes in Broadcom, Caris Life Sciences, and Revolution Medicines. The pivot is unmistakable, away from consumer-facing tech giants and into semiconductor infrastructure and biotech innovation. This isn't random churn, it's a structural shift in where Duquesne sees future value creation. Third Point also entered Hut 8 mining and SPDR Gold shares, signaling a broader repositioning into crypto and hard assets. The important part is not just the exits, but what they reveal about changing incentives. Druckenmiller exits Alphabet during a period of underperformance suggests a lack of patience for valuation premiums without near-term catalysts. Meanwhile, TCI's expansion into Alphabet and Third Point's new crypto bet indicate that other top-tier managers see opportunity in volatility. The filings don't say why these moves were made. Was Druckenmiller spooked by regulatory risk, AI competition, or ad revenue trends? Or was this simply a rotation into higher conviction names like Broadcom? We're reading the tea leaves of 13F filings, not press releases. That means while we can confirm the moves, we can't confirm the motives. And that uncertainty is where the real risk lies for retail investors. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. A whale exit warning sign like this can trigger follow-the-leader selling, but it's dangerous to assume all billion-dollar funds see the same picture. TCI and Third Point are clearly betting against Druckenmiller's call. The market, so far, agrees. Alphabet is up 27% in 2026, but momentum doesn't guarantee sustainability. The next signal to watch isn't a price target, it's the next round of earnings and guidance from Alphabet. Can the company deliver growth that justifies its valuation and silences the skeptics? Because until then, the split among titans like Druckenmiller, Hohn, and Loeb means one thing: the debate over Alphabet's future is far from settled. Druckenmiller may be the headline, but the real story is the fracture line it exposes among the elite.